It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise, to navigate the best moves for your portfolio. Today we're taking a look at rate-sensitive names, and I'm here with Tolou Capital Management founder and Chief Investment Officer Spencer Hakimian. And let's start with the stock that you're bullish on, and that is JPMorgan. The stock, it's had a little bit of a pullback here lately, but it was recently trading at a record, and the stock is up quite a bit, I think more than 30% over the past year. So let's get to why you still like it and you think it still has more upside. So there's been a lot of talk about the new administration coming in and sort of lightening up regulations on the banking industry. How is that going to benefit JPMorgan?
So, as it relates to big banks, especially commercial banks, Basel III and other regulatory updates that are coming along are going to, at least it's strongly considered by the sector, to help improve profitability. It's going to require less capital up front. And generally speaking, that will help to increase returns on equity, net interest margins, and it'll generally just make a more favorable environment for lending for all big banks.
And their profit margins have already, largely recovered post-financial crisis, right?
Currently, right now, return on equities for a big bank like JPMorgan is basically as high as it's been definitely since after GFC, but even before GFC, we're at like 2005, 2006 prices. So levels. So it's great, and it looks like it may even get a little bit better for banks.
And then also on the sort of macro, big picture policy front, we could be seeing tax cuts coming, or at least an extension of the existing tax cuts. Why is that going to be good for JPMorgan?
Well, at the end of the day, a tax cut will one way or another lead to extra deposits that will flow to all banks. Naturally, JPMorgan being the biggest bank in the United States will get a big amount of those deposits. And these types of deposits tend to be some of the cheapest deposits that banks get in terms of their funding cost. And that's great because they can lend it out, they can go buy US Treasuries with it, they can do a host of activities with it. And, generally speaking, deposits up for a bank, profitability up for a bank. So that's just something that we're keeping an eye on as we get towards Easter and those tax cut conversations begin.
Yeah, speaking of taking it in and lending it out, let's talk about net interest margins, right? Because we've got this sort of higher for longer environment. What does that imply for a bank like JPMorgan?
So it's actually ironically been one of the best things that could have happened to banks, especially the big banks, since late 2022, because big banks have a much lower funding cost than the small regional banks do because of a presumed assumption of safety with dealing with a bigger bank. And because that yield curve is expensive, they're lending out that money at, let's say, 200 basis points above the 10-year. They're getting a very nice interest on their money, and at the same time, rates on, let's say, a checking account have hardly moved at all, and the flow to, let's say, accounts that actually pay a yield, although it's been big, it actually hasn't been so big as a proportion of banks' total, deposits, which are their liabilities. So this is just, we think it's a great environment, and I think we're seeing it in higher ROEs, higher net interest income margins. We think we're seeing it all around.
We have been seeing it, certainly for JPMorgan. So what could go wrong? Let's talk about that. If indeed, there have been some slowing growth concerns creeping into the market here. What would that mean for JPMorgan? And I guess how likely do you think that is also?
So at the end of the day, a bank is, it's a leveraged investment on the growth of the economy. They're lending to the economy. So if defaults were to increase, if credit card charge-offs were going to increase, if people were to default on mortgages, people started losing jobs, this is all going to negatively impact JPMorgan. JPMorgan happens to be one of the more conservative banks in terms of their balance sheet. But nonetheless, anytime you get an increase in defaults and banks are a levered business, it's going to hit them disproportionately. We saw it 2008, we saw it Q1 2020, we saw it in 2023, although that technically wasn't an economic issue. So that's always the big risk when you're dealing with a bank if the economy were to go soft. But with JPMorgan, they are one of the most financially conservative large banks. They hold a lot of cash relative to their required capital. And they have such a big exposure to short duration treasuries that they could adjust their book pretty easily if we were to get into a recession. So if we were to get into a recession, they would be one of the better performing banks in that scenario.
And before we move on to the stock you don't like as much, do you guys hold JPMorgan?
No, we have exposure to the financial sector, but no individual security.
Okay, gotcha. All right, let's get to the stock that you don't think is as good a buy here, and that's D.R. Horton, the home builder. Those shares haven't done very well over the past year. So let's get to what's going on in terms of supply and demand, which is a big deal for the home builders. You say there's oversupply in the Sun Belt at this point.
Without a question.
Yeah.
A lot of the oversupply started in the aftermath of COVID, and as people were leaving the northeastern states towards Florida, towards Texas, towards Georgia, builders responded with excess inventory. And as always, inventory tends to, people get a little bit too excited and build too much relative to what actually ends up happening. That population growth decelerated, and now we're in a situation where Florida is oversupplied, Texas is oversupplied, we're seeing parts of the Carolinas start to get somewhat oversupplied. And at the end of the day, this is a builder that has to move inventory. So if it can't move it, it's going to have to lower its price. And that's a lower margin, profit margin than what the Wall Street may be expecting.
Right. Margins have been a big focus, I know, for investors. Whereas policy might be positive for the likes of JPMorgan, maybe not so positive for D.R. Horton on a number of different fronts.
Yeah.
Whether we're talking about tariffs or immigration, walk me through that.
Sure. So let's just start with tariffs. Higher steel prices, higher aluminum prices, higher, any type of raw material prices. That's all going to feed into higher home prices. At the same time, when you have that oversupply, it's very hard to justify making your customer base absorb that cost. So if you were to model it out, you would expect that more of that cost would have to be absorbed by the home builders rather than by the consumers. And that would, again, lead to lower profits. And then again, housing is just a function of population growth to a pretty big extent. Less immigration, whether it's good or bad for, politically, that's just going to mean less people than what was, priced in, let's say, in 2023 or 2024. And if that happens, there's just simply going to be a little bit less demand for housing. And that means, again, builders are going to, we might see supply build up, and it could be a hard situation for builders in 25 and 26.
And then there's rates, which cut both ways, right? We had talked about the JPMorgan upside. Obviously here, high mortgage rates have been a real issue for anyone buying a home, whether it's a new home or an existing one.
Definitely. And specifically in the case of D.R. Horton, they're selling new homes. So the new home market does not have the people that are insulated from rates that are stuck in those 2021 2% rates. These are all people that are going to have to assume a new mortgage. So the demand for a new home is a lot lower than the demand for an existing home. At the same time, D.R. Horton, to try and move inventory, does something called a rate buy down, where they subsidize a portion of your mortgage for a couple of years. And again, that's just expensive. These are all things that are raising the costs for home builders, and at the same time, we don't see the demand out there for new homes right now.
And then finally, I guess what could switch the thesis here on D.R. Horton if we see a longer-term decline in rates?
If we can somehow manage to get the long end of the yield curve, so 10s to 30s, to fall sustainably, and for a long amount of time, not just for a month or 2 months or 3 months, but for half a year, year and a half, while not having the economy fall into some kind of recession. Because the long end usually falls when we're in a recession or a growth scare. If we can somehow manage to get that, we can eventually move these homes. Consumers still have jobs, they still have cash, asset prices are just off all-time highs. So consumers can buy homes if rates get a little bit more affordable and the economy is still there. So things can always change.
Things can always change. Spencer, thank you so much for coming in. Really appreciate it. And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern.